Hello viewers, welcome to DLS tutorials. Yeah, on this channel we do cover lessons in all the business related courses, that is financial accounting, financial reporting, public sector accounting, corporate reporting and the likes. But today I want us to look at one of the basic and fundamental accounting standards, that is IS-12, income taxes. As we all know, tax systems may differ from country to country. Therefore, it is practically difficult for us to have a uniform system of accounting for tax across the world. So, IS-12 tries to cover the general principles for accounting for tax in the financial statement of entities. So, IS-12 covers only two types of tax, and these are: we have current tax and deferred tax. But in this lesson, we are going to cover only current tax. Okay, so we are going to look at only current tax. But how does the standard define current tax? The standard define current tax as the estimated amount of tax, estimated amount of tax payable on the taxable profits of the entity for the period. So IS-4 defines current tax as estimated amount of tax payable on the taxable profit of the entity for a period. But what then is taxable profits? So what then is taxable profits? So when they say taxable profit, they are basically referring to the amount of profit on which tax is payable. So the profit on which tax is payable is what we call taxable profit. This is always calculated in accordance with the local laws of the country in which the entity operates in. So if the entity operates in Ghana, they want to determine the taxable profit of the entity. They are going to use the tax laws of Ghana to determine the taxable profit of the entity. And this calculation is always done in the next accounting period. What does that mean? It means that the taxable profit of the entity will not be known by the entity until the financial statement of the entity is submitted to the tax authority for the computation of the taxable profits. So it is in the subsequent period that the true amount of the tax payable by the entity will be known to the entity. But since tax is one of the legal and corporate responsibility of entities, IS-12 is saying that at the end of every financial reporting period, entities should estimate amount of tax in their financial statement. So at the end of the year, IS-12 is saying that, assuming 2021 year end, IS-12 is saying that since it is a legal responsibility of every entity to pay tax, just make an estimate of any amount. It can be based on your previous performance, any amount, and put this amount in your financial statement. So when an estimate of $25 million is made at the end of the reporting period, how will the entity account for this? Tax is an expense, so the entity will debit profit or loss account, and this is amount payable. The entity is going to pay this amount to the tax authority of the country. So this indicates an obligation at the end of the reporting year. So the entity has to create a liability, which is a current liability. So the entity has to credit tax payable account, which is a liability, tax payable account, which is a current liability, because the entity is going to pay this amount in the subsequent period, which is the next year. All right. So ISOP is saying that at the end of every reporting period, companies are to make an estimate of the tax that they are going to pay. They should assume that this is the amount that we are going to pay. And when that estimate is made, what are they going to do? They are going to they are going to debit a profit and loss account with the estimate. And also create a liability because this indicates an obligation at the end of the reporting period. So since this is an estimate, there can be issues that will arise. Issues will arise from this one because we don't know the true amount and we are making an estimate. So it can happen that in the subsequent year, which is the 2022, it can happen that after we submitted our financial statement to the tax authority, the actual amount of tax or the true amount of tax will be less or more than the 25 million. So assuming in 2022, after we submit our financial statement to the tax authority, they were able to come with a true amount of 27 million. What is happening here? It means that, or if you can see clearly, it means that we estimated for 25 million, but the tax authority has given us what? A true amount of tax payable of 27 million. What is happening? We have underestimated our tax provision. So, in current tax, there are issues that will arise from that one. Let's also assume that in this 2022, the actual amount is not 27 million, but it is 23 million dollars. What is happening? The amount that we estimated is higher than the amount that we're supposed to pay. So this is also over provision. So under current tax, we have two issues. These issues are over provision and under provision. So we are saying that under current tax, we have two issues. It's either under provision or over provision. But how do we account for this? And how do we ascertain this is an over provision or this is under provision? So we are saying that under current tax, we have two issues here. We have under provision and we have what we call what? Over provision. Over provision. So how do we determine this is an over provision or this is an under provision? Assuming the entity made an estimate in 2006 for tax, which is tax, the entity made an estimate of 25 billion in 2006. But we are saying that the tax will be paid by the entity, will be given to the entity by the tax authority in the subsequent year. So in 2007, the tax authority or the actual tax given to the entity was 27 million. What is happening here? We estimated for 25 and now 27 million was given to us. What is happening? We have underestimated. So in this case, this is under provision. When do we say that it's under provision? When the actual tax payable is higher than the tax estimated by the entity, or when the estimated amount by the entity in the previous year is lower than the actual tax figure given to the entity by the tax authority, we say that we have under provision. So in this case, you can see that there is under provision of 2 million. How will the entity account for this? We come to that later. Let's assume that the same 2006, assume that this hasn't happened, but the entity tax was 25 million. But in 2007, which is the subsequent year, the actual tax given to them was 23 million. What is happening? The entity estimated more than what is supposed to pay. So we have over provision of what? 2 million. So when then we say there is over provision, when the actual tax is lower than the estimated amount, or when the estimated amount is higher than the actual tax to be paid by the entity, then we say that this is over provision. So assuming that for 2006 year, 2006 year, the entity profit before tax. So let me put the currency sign here, which is in dollars. So the entity profit before tax was 200 million, but the current tax or the estimated tax was 25 million, which will be less from this one, 25 million. Then the entity is going to have 175 million as a profit for the year or profit after tax. Okay, so let's assume that in the subsequent year, which is 2007, the tax authority now gave the entity the actual tax to be paid, or the true amount of the tax to be paid, the true amount of the tax to be tax given by the tax authority to be 27 million. Okay. How do we account for this? Assuming the entity should have been aware that the tax to be paid for the year is 27 million. This is how the entity is going to account for this. The entity is going to have a 200 million, all right, but the tax figure will be 27 million. So the entity will be having a profit of 173. But the entity doesn't know that this will be the tax to be paid. But they accounted for only 25 million. So in this case, this 175 million will be sent to the retained earnings of the entity for 2006. So this 175 will also be brought forward as the retained earnings balance for 2007. So let's assume that in the retained earnings of the entity, the balance of that is 175 because we are dealing with only the 175 million. But this should have been 173 as we know the 27 to be the actual tax. So what are you going to do? The entity can say that okay, tax is an expense. So the increment is also an expense. So let's go and then it is let's go and supply the 2 million over here to make it 175. No, you can't do this. Why you can't do this? Because this is an estimate. So increment or decrease should be treated as a change in an estimate. So this should be treated as a change in an estimate in accordance with IS 8, changes in accounting policies, estimate and errors or correction of errors. So these 2 million should not be treated retrospectively, but rather prospective. Okay, so assuming the current year, which is the 2007, the entity profit before tax is $250 million. So, and the entity is going to make an estimate of, let's say, 28 million. So, what should happen? The 2 million, which is the underestimate, should have been subtracted before, but we didn't do that. So, we are coming to subtract it in this year. So, we can say under provision of 2 million, which will be subtracted. Then we come to the current year estimate, which will be tax, which is 28. So we are going to have 220 as the profit for the year or profit after tax. You see, you can see that these two are all reducing the profit. So it will be ideal or it will be good or it will be better for us to just put the two together because they are all related to tax. So for 2007 year, we can also come and prepare our tax schedule. Our tax schedule. Then we have the current year estimate, 2007. We have our current year estimate, current year or current tax, current year estimate of 28 million. Then we have the under provision of 2 million. Then we have 30 million. So instead of us subtracting this and this, we just do volume one, which is we just write tax here. Then we put 30 here. Then we just put a 30 here. We have a 220. Then we just say if this is working 7 or working 2, we just put the workings there. So under provision is added to the current year estimate. Then then the final figure is being sent to the statement of profit or loss account. But what about over provision? How do we account for over provision? Assuming in 2006, the entity profit before tax was 200 and the tax estimate was 25. So the entity is going to have a profit of what? 175. Assuming in 2007, the actual tax was 23. So in this case, assuming we know of these 23, the statement of profit or loss should have been like this. Then we have 23, then we have 177. But we don't know, so we have 175. But this 175 will be the retained earnings of the entity. So don't go and say there is over provision of 2 million. Then you go and add the 2 million to this one. This is a change in our estimate. So what is this one? This is a decrease, which is an income. Go to the current year statement of profit or loss and add this one. So assuming the statement of this, the current year statement of profit is the same as that one for the under provision. We are going to have a tax which is a 28. So we go and we come and add over provision of 2 million. And we now put the current year tax of 28 million. What is happening? You see that this will then this one to be 26. So when there is over provision, what we normally do is that since this will net this, just come and prepare our tax schedule, then we net this one again, this one. Then we have 26. So if it is under provision, we add the under provision figure to the current year estimate. If it is over provision, we subtract it from the current year estimate. But let's show the double entry for this particular transaction. Sometimes in the trial balance of the entity, they will put some figures on the debit side and then the credit side, showing over or under. So let's show the double entry over here. So that anytime that you see a current tax on the debit on the credit side, it means over or under provision. So let's show the double entry over here. So assuming our current estimate for 2006 was $25 million. So this will be an expense at the same time liability. So we go to our tax payable accounts. Then we have, so this will be 2006, which will be a balance drawdown for 2007. So in 2007, we have balance drawdown because this is a liability, 25. Assuming in 2007, the actual tax is given to the entity by the tax authority, which is 27 million. So this will be paid either by cash or by check. So we can either cash in the bank because this transaction we are going to debit tax payable account and credit the cash book. So we come here, we have 27. So what will happen? We are going to have balance of this, balance carried over here of 2 million. So we close this account. We also close this account. So what is happening? We are going to have balance of this, which is what? 2 million. But we are paying more than the estimate, so this is under provision. So anytime that you see a current tax on the debit side, it might be the tax paid or under provision. So the footnote will tell whether it is under provision or the tax paid for the year. Okay. Let's assume that there is over provision. So the actual tax estimate for last year is 25 million. But the tax given by the tax authority is 23 million. So we are going to pay into 3 million. So what will happen? The credit side is more than the debit side, so the balance can be now will be here, which is 2 million. So in this case, we are going to have we are going to have 25, but the balance will come here 2 million. What is happening? We are paying lesser than what we estimated, so we have overestimated our tax. So whenever you see the balance of current tax in the trial balance, which is on the credit side, it means over provision or the tax liability of the entity. So the footnote to the trial balance will tell you whether it is over or under. So when there is a question on tax, they say that the tax account has a credit balance of this. That means that there was there was an over provision for the previous year. But whenever you see a debit balance, it means that there was under provision in the previous year. So credit means over, debit side means what? Under. So we are going to pick two questions so that we drive home the topic relating to current tax. Current tax is all about over provision and under provision. Don't forget, we say that at the end of every year, the IS 12 requires entity to make an estimate of any tax that they are going to pay. They should create a provision of tax payable. And when they create this provision, they should debit P&L account and also create a liability because the estimate indicates an obligation at the end of the reporting date or the reporting period. So that is all about current tax. So we are going to pick two examples, then we see how we account for current tax. I'm going to pick two questions on the current tax. They are all, it may be under or over. We are dealing with over or under provision. So check the comment section. You see the PDF form of, you see the PDF of the question in the comment section. So let's pick the question one. The question one is on the links limited. So the question says that IS2 of income taxes set out guidelines for dealing with under provision and over provision of income tax by reporting entities. During the year ended 31st March 2019, the Links Limited finalized and paid its liability for corporate tax on profit for the year ended 31st March 2018. So we are reporting for 31st March 2019. So the reporting period is 2019. Take note of that, it's very important. So at an amount of 21 million Ghana cedis, the currency city over there is Ghana cedis. So in 2019, we paid a tax of 21 million in respect of a tax liability in 2018. Okay. It had previously made an estimated provision for corporation tax of 25 million in the financial statement for the year ended 31st March 2018. So the estimate for 2018 was 25 million. That was the estimate for 2018. But in 2019, we paid 21 million in respect of this particular provision. Okay. The directors estimate the liability for the year ended 31st March 2019 at 24.5 million. So the current year estimate, the current year estimate, the current year estimate is 24.5 million. So basically, we estimated 25 million in 2018. But in 2019, we paid 21 million in respect of this estimate. So what is happening? We paid lesser than what we estimated. So this is an over provision because the estimate is higher than the actual, or the actual is lower than the estimate. So the question is saying that required explain the treatment of the above transaction in the financial statement of the Links Limited for the year ended 31st March 2019 in respect of what? Taxation. So first of all, you have to establish whether this is an under provision or over provision. So in respect of 2018, there was an over provision of 4 million. How did you get a 4 million? It is the estimated amount minus the actual. So there was an over provision of 21 million, which was estimated in respect of 2018. So in 2019, the figure that will be shown in the statement of profit or loss account. So we have to prepare our tax schedule. It will be the current tax, which is 24.5. Then our over provision, we should have subtracted 21, but we need this one. So we come and add, we come and make adjustments here. So we have over provision of 4 million. So in for the current year, the tax amount, the current tax amount that will be shown in the statement of profit or loss account will be 20.5 million. How do we get a 20.5 million? We net the over provision against the current year estimate. However, the current year estimate of 24.5 million indicates an obligation at the end of 2019. So this will be sent to the statement of financial position as a current liability for the year. So I'll take it again. There was an over provision in respect of 2018 of 4 million. How do you get a 4 million? We estimated for 25 million, but we paid 21 million, so we overestimated our current tax by 4 million. So in a statement of profit and loss account, the figure that will be taken there in respect of current tax or tax will be the 24.5 million, which is the current year estimate, minus the 4 million, which is the over provision. So at the end of the day, the net effect will be 20.5 million. That will be shown as a tax figure in the statement of profit or loss account. But for this 2019, which is the current year, we are making an estimate of what? 24.5 million. This is an obligation, so we create a liability in the statement of financial position in respect of what? Tax, which is 24.5 million. So this is all about this question. We move to the next question. Okay, example two. Example two is about DLX Limited. So the question is saying that DLX Limited manufactures and distributes security equipment. DLS prepares financial statements in accordance with International Financial Reporting Standards, which is IFRS, up to 31st August each year. On 31st August 2019, on 31st August 2019, so on 31st August, on 31st August 2019, the, the taxation liability account in the books of DLL Limited show a debit balance of, so there was a debit balance, there was a debit balance of 17,500 after paying the 2018 liability. So in the taxation book or in the tax payable account of DLL Limited in 2019, after paying its liability for 2018, there is a debit balance of 17,500. Okay. The estimated liability for 2019 is 84,500. So the estimated for 2019, is 84,500. 84,500. Okay. And no entry has yet been made to record this. Requirement. Required. Explain the appropriate accounting treatment of the above transaction for the year ended 31st August 2019. So they are saying that after paying the actual tax for 2018, there was a balance of 17,500 on the debit side of DL Limited taxation accounts. So this debit balance indicates under provision. So there was under provision in respect of 2018. But so the figure there was under provision in respect of 2018. And in 2019, estimate of 84,500 has been made. But how are we going to account for this? Which figure will go to P&L account? The P&L account, we have the estimate, current estimate of 84,500. Then what will happen? Under provision means that we are subtracted less than we should. So we come and add this one to it. So we have 0, 0, 0, then we have 2, then we have 10. So in the current year statement of profit and loss account, the under provision will be added to the current year estimate to have a figure of 102,000, which will be sent to the current year statement of profit and loss account as the tax amount. But what will happen to the statement of financial position? We are making an estimate of 84,500 for the year. This is an obligation at the end of the year. So this will be sent to statement of financial position as a current liability. The question 1 and 2 is only about current tax, but the subsequent questions are about their the combination of the two, which is the current tax and the deferred tax. So in our next video, we'll look at deferred tax. Thank you for joining. So just keep checking on the channel, subscribe, because a lot will be coming on your way. Financial management accounting, every topic in the ICA and ACC ICANN syllabus, we are going to cover a tutorial or a lesson on that. So just keep checking on the channel often as we proceed. Thank you.